In 1998, a single hedge fund controlled positions with a face value north of $1 trillion, built on less than $5 billion of its own money. Its partners included two winners of the Nobel Prize in Economics and a former vice chairman of the Federal Reserve. Within 4 months, it was effectively gone. This was not a fund that bet wrong on a stock. It was a machine engineered by the smartest people in the market, and it failed in a way its own models rated as impossible for the entire age of the universe. When it broke, it threatened to take the balance sheet of every major bank down with it. This is the autopsy of long-term capital management. The firm was founded in 1994 by John Meriwether, formerly the head of bond arbitrage at Salomon Brothers, who brought most of his old trading desk with him. On the board sat Myron Scholes and Robert Merton, who would share the 1997 Nobel Memorial Prize for the mathematics of pricing options. That prestige was not decoration. It was the fundraising engine and the source of an aura of invincibility. The terms told you who held the power. 2% of assets as a management fee, 25% of the profits, and a 3-year lockup on your money, richer and more restrictive than almost anything else on offer. Investors accepted it because the returns were staggering. After fees, roughly 20% in the partial first year, 43% in 1995, 41% in 1996, and roughly a quarter in 1997, its softest year. Here is what the machine actually did. It did not bet on direction, not on rates going up or stocks going down. It bet on convergence. Find two instruments that are almost economically identical but trade at a small price gap. Buy the cheap one, short the expensive one, and wait for the gap to close. Each spread was tiny, often just a handful of basis points. A few basis points is a rounding error. The only way to turn a rounding error into a hedge fund return is leverage. LTCM financed its positions through repo agreements at almost no haircut, stacking borrowed money on top of each thin spread. Individually, the models said, these trades were low risk and uncorrelated. That single assumption is where the fund died. Look at the structure and the tell is obvious. In every one of these trades, LTCM was long the illiquid instrument and short the liquid one. It also sold long-dated stock index options in enormous size, so consistently that dealers nicknamed it the central bank of volatility. Strip away the costumes, and it was the same bet 40 times over. Short liquidity, short volatility. The signature trade was on-the-run versus off-the-run treasuries. Short the newly issued, richly priced benchmark bond. Long the nearly identical older bond trading a hair cheap because it was less liquid. Add swap spreads, mortgage spreads, European government bond convergence, and paired shares like Royal Dutch and Shell. In calm markets, all of it grinds slowly in your favor. You clip coupons and collect premium. By the end of 1997, the partners decided there was too much money chasing too few opportunities, so they returned roughly $2.7 billion to outside investors, while keeping the positions the same size. That single decision mechanically cranked the leverage higher. Entering 1998, the fund had about $4.7 billion in equity supporting $129 billion in assets, and around $1.25 trillion in derivatives. Then, on August 17, 1998, Russia devalued the ruble and declared a moratorium on tens of billions of its own domestic debt. A nuclear power was defaulting on debt denominated in a currency it could simply print. Almost no risk model on Wall Street priced that as plausible. The default itself was small. The reaction was not. What Russia triggered was a global flight to liquidity. Every leveraged player on Earth dumped anything risky or hard to sell and crowded into the single safest, most liquid asset available, on-the-run U.S. Treasuries. Now trace it through LTCM's book. The liquid bonds it was short got bid up. The illiquid bonds it was long got sold off. Every spread that was supposed to converge instead blew wider. This is the heart of the autopsy. LTCM believed it was diversified across bonds, mortgages, equity volatility, and European sovereigns. But every position shared one hidden common factor, the price of liquidity, and in a panic that factor spikes everywhere at once. The correlations the model assumed were near zero went to 1. 40 independent trades became a single trade, all losing on the same day. From there it became a doom loop. The marks moved against the fund daily, and its repo lenders and swap counterparties demanded more collateral, now valuing that collateral at liquidation prices, not mid-market. To raise cash, LTCM had to sell into the very illiquid markets where it was long, pushing those prices down further, widening its own spreads, and generating the next round of losses. You cannot delever when your own selling moves the market against everything you still hold. May had already cost the fund 6.4%, June another 10. By the end of August, it had lost roughly $1.85 billion of its capital, nearly half the year's equity, and it reportedly dropped more than $500 million in a single day. Then the clearing broker, Bear Stearns, demanded about $500 million more in collateral and signaled it would stop clearing trades if the cash box ran dry. That threat put a clock on the endgame. September was the freefall. On September 2nd, Meriwether wrote to investors that the fund was down about 52% for the year and offered new capital on special terms. It did not stop the bleeding. Equity fell from roughly $2.3 billion at the start of the month toward the low hundreds of millions by September 25th. On paper, as the denominator collapsed, effective leverage blew past 100 to 1. In the final days, a real lifeline appeared. A group led by Warren Buffett's Berkshire Hathaway with Goldman Sachs and AIG offered roughly $250 million to buy out the partners and about $3.75 billion to recapitalize the fund. The offer lapsed. Whether it died on ego or on a legally impossible deadline is still disputed, but it died, and that left one option. The Federal Reserve did not care about Meriwether's investors. It cared about the plumbing. That trillion-plus dollars of contracts sat, unnetted, on the balance sheets of virtually every major dealer, more than 17 significant counterparties. A disorderly default would have forced all of them to seize and dump the same illiquid collateral into a frozen market at once, repricing assets everyone else held, and triggering LTCM's death loop across the entire street. So on September 23, 1998, the president of the New York Fed, William McDonough, convened the major creditors in a boardroom on Liberty Street. Understand what happened and what did not. The Fed put up no public money and lent nothing. It supplied the room and the pressure. 14 banks and brokerages injected about $3.625 billion for 90% of the fund, leaving the partners with roughly 10. 11 firms put in $300 million each. Societe Generale added $125 million, Paribas and Lehman Brothers $100 million apiece. 2 firms declined. One was Crédit Agricole. The other was Bear Stearns, LTCM's own clearing broker, already first in line to be made whole, which decided that saying no cost nothing. 9 years later, Bear Stearns would need a rescue of its own. Given time instead of a fire sale, the positions did what LTCM always said they would: they converged. The consortium wound the book down over the following year, was repaid in full by December of 1999, and even earned a small profit. The original partners, whose personal stake of nearly $2 billion was diluted to almost nothing, were the ones wiped out. The Fed also cut interest rates 3 times that autumn, and critics have argued ever since that the mere act of convening that room taught Wall Street a lesson: get large enough and interconnected enough, and someone will organize your rescue. That precedent, the too interconnected to fail template, is the line many analysts draw straight forward to 2008. Meriwether, for his part, launched a new fund almost immediately, running the same playbook at lower leverage. It, too, eventually closed in the next crisis. Here is the verdict. LTCM did not die of a bad bet on Russia. It died because its entire book was one leveraged short position on liquidity, dressed as 40 diversified arbitrages, financed on daily margin. When the flight to liquidity hit, every spread diverged at once, and the collateral calls forced it to sell into markets only it was making. The thesis was right. The spreads did converge. But being right is worthless if your financing forces you to liquidate before convergence arrives. Leverage does not change your expected value. It changes whether you survive the variance.